Hi guys, so today we will cover part 2 of chapter 14. We continue to talk about options. Let me share my screen and I think we are going to start. So last time we stopped on the question what kind of parameters we have to use to estimate the value of an option. And there's going to be 5 main parameters we have to use. The first one will be obviously the price of underlying financial asset. So let's say if the option is for Apple, if the stock price of the Apple will fluctuate, obviously the option value will also fluctuate. Sometimes it will be in the money, so the option price will be more valuable. Sometimes it's going to be out of the money. So the option of the option of the stock will be worthless. Next, the option strike price. Again, Apple is the first factor. Second one is the strike price itself. Let's say Apple $100. The amount of time remaining to expiration. Again, if the option is alive for next 3 months, it's going to be more valuable than the option that will expire tomorrow, because you will have more probability and more time to wait and capture the moment where the option will be in the money and you will get the return. The underlying asset volatility, again, quite intuitive idea. If the stock is more volatile, there's going to be more moments where the option will have positive value and you will be able to realize the profit from this option. And finally, the risk-free rate. So the higher the risk-free rate, usually the put option will be less valuable, but the call option will increase in price. And so the sixth factor, which is kind of minor and going to be not that important for our formula to estimate the option price, will be the dividend yield. Intuitively, you can think about this idea that if the company will pay more dividends in the future, then the stock price will decrease in the value in the future. And so then the call option to right to buy the stock for the expensive price will be kind of less valuable. So usually the dividend yield goes in the opposite direction with call option, but in the same direction with put options. So dividend yield goes up, the put options go increase in value, but the call will decrease. So the question is how to use all of these 5 parameters to estimate the value of a call option. And the groundbreaking model that was proposed in 1973, for which the Black-Scholes won a Nobel Prize, was a model where they tried to estimate what will be the call option if the stock just follows a random walk. Assume we don't have any information about the future inside of the company, like how it's managed or what will happen in the future. Let's assume that the stock is just a random walk that goes like in sort of a Brownian motion. And if we have these 5 parameters ready, what will be the call price based on these parameters? And so essentially we can conceptually understand the call price as a strike price, which is S in this case, and multiply by N of D1. And so N of D1 will be a probability ranging from 0 to 1 if the value of the stock will move closer to the in-money position or more out of it. And then we subtract present value of the strike price, again, which is in our contract, multiply by another probability that the likelihood the option will end up in the money. And so in the sense, we can view this formula again as a idea that stock price follows a random walk, and if it has the certain time to expiration, certain volatility, then what will be the chance that it will be actually worth something at some point in the future. And so how we calculate these probabilities. So here is the formula for D1 and D2. I don't think I will ask students to calculate the Black-Scholes model in the exam, but the intuitive idea about this is very important. Essentially, they capture the important inputs: the stock price, strike price, time to expiration, volatility, and risk-free rate. So they combine those probabilities to come up with the value of an option. So think of D1 as capturing the stock expected future price adjusted for risk, and D2 is the probability weighted likelihood that the option will finish in the money. And so you can see that volatility and time will be important factors. If the volatility will go up, both D1 will increase in price and D2 will decrease in price. So this means that the strike price will have the larger portion multiplied by 1, and the minus present value of the stock multiplied by the probability of D2 will be actually decreasing, because we have D1 minus standard deviation square root of T. And so both if standard deviation and time to expiration will increase, the value of the option, this one, should go up. Now, which portion of the formula will have larger impact, standard deviation or the time to maturity for the overall value of the option? It's going to be the standard deviation, because you can see that in the D1 it has this squared root, squared over here, and here also the standard deviation is without any squares, but T is in the square brackets. So usually standard deviations will be more important factors when we try to estimate the call option value. So again, kind of a visual idea what we try to estimate using the Black-Scholes model. So in this example, let's say we calculate our D1, probability of the D1, and it's going to be equal to 0.8159. So what this essentially means is that there is 81% probability under the model assumption that the option will finish in the money. Or put differently, 81% chance that the stock price will exceed the strike price at the expiration. So the stock price in the future will exceed the stock price, strike price at the expiration, this one. And so usually, one problem that we have is that usually stocks do not really follow the normal distribution. The biggest assumption of the Black-Scholes model is that the stock prices follow the kind of a normal distribution curve. Usually the stock return are 0, and then there's going to be tails to the left and right. And unfortunately for us, usually the normal distribution is not really good representative for the stock prices. And usually stock prices and stock returns have this much more fatter tail. And this in turn will kind of underestimate the probability that the call option will have a positive value. It will end up in the money. So this is kind of a limitation of Black-Scholes model, and nowadays in the market we have many sort of adjustments to the Black-Scholes model. So next, we switch from the evaluating the option to the question how these options are used by different market participants. Again, as we previously discussed, two great advantages that options provide to us is leverage. We can actually manage big amount of capital without having many capital at our hand. And second is the limited exposure to the losses. Again, if the stock will go not in the direction we initially anticipated, the worst case scenario for us is that we will lose the option premium. This $5 or $2 we paid per contract to buy the option. But we don't really lose anything below that. In the case of the win, however, we capture all of the gains. And the kind of downside of the options is high risk. Usually options will either give you very high returns in the terms of hundreds and hundreds of percentages, but on the other hand, you can actually very quickly lose your option premium if the option will expire, and essentially your rate of return will be minus 100%. So there's really quite big volatility when it comes to the option returns. And so how do we use the option contract? And we will talk about this in the future. So here, let's look at the very brief example how this high volatility manifests itself. So let's say we have 3 scenarios. The first one is that we buy 100 shares for $49 per share of the stock. And after some time, 6 months later, we actually are able to sell for $65. So what will be our return in the case of using option and not using an option? So if we just buy the stock for $4,900, we just sell it for $6,500, our return will be $1,600, which is 33%. Quite good results. Now, what we can do instead is that we can actually buy the call option to buy the stock for $40. And so here you can see that the per contract value will be $11,000. So you have to pay $11 per option contract. So the break-even point will be what? 11 plus 40, $51. At $51, you will be at break-even. Your returns will be 0. And so if the stock price will go to the $65, you will sell these options on the market or exercise the contract, whatever you want to do, and your additional return will be $2,500. And so your initial price was $1,100, so $1,400 you actually made, which is 107% rate of return. If the strike price was $50, let's say, and you paid only $5.3 per contract, then your returns will be even higher, 183. So this again illustrates the point that usually options are associated with very high returns, but these high returns are associated with very high risks. So how these options are used in the real world, the most common example is hedging. So essentially the hedging is the combination of different financial instruments to limit the risks. So in the case of the hedging, we're kind of satisfied with our returns. What we, however, want to manage is our risks. And so what people usually do is that they buy some sort of a combination of the stock and the option to limit their risks. And so one of the most popular examples are protective puts. So what we do in the protective puts is that we buy long the stock itself. So we hold the stock at our hand and we buy a protective put option. Why we do this is essentially we want to protect ourselves from the losses. If the stock prices will drop, then we will exercise our put and lose nothing except the option premium. On the other hand, if the stock price will increase in the value, then we will capture all of the benefits. So in this sense, the protective puts serves as a insurance, so to speak. And insurance is not free. You have to pay the premium for that. So let's consider a potential scenario. So let's say we buy a stock for $25. And we buy 100 of them, and we not only buy them, but we actually buy protective puts, $1.5 per contract. And so let's consider 2 scenarios. The stock price increased by $50. And so in this case, what we do is that we simply sell our stock option. Our return is $2,500. we did twice as many as we initially invested, but we actually have to pay $150 to pay for the options. So our profit will be $2,000, $350. In the situation where we don't buy put option, but we would have $2,500. So alternative scenario, however, if the stock price will decrease to $10, then we will not lose that much. Why? Because we actually buy the put option to sell the stock for $25. So what we actually will have as a result is that we have to sell. So essentially, we sell the stocks for $2,500 and then pay the option contract. So our loss will be $150, the amount we actually invested to the option contract. So essentially, the worst case scenario for us was a $150. What would happen if the stocks actually decrease to zero? Again, the amount we will lose is only option premium. So we have this cap on the worst case scenario. And without the put option, we would lose just $1,500, which is quite bad. Another strategy is that we can not only protect our downfall, but we actually can protect the profit. So what we can do is that we can actually buy the stock again for the long run. And then if the stock price actually increased, what we can do is that we can buy put option for the higher price than we initially buy the stock price for. And in this case, we kind of create a ceiling for how much money we earned, at least. Again, very good strategy if you want to kind of save your profits because you have kind of further plans what you want to do with these profits going forward. So again, let's consider the scenario here. Let's say we bought stocks for $35, and after some time, the price of the stocks increased to $75. So we made out of the money. What we can do is that we can buy protective put for $2.5 per contract, which will kind of lock our gains at this $75 threshold. And so if let's consider this scenario first, is if the stock prices will increase to $100, then we just don't exercise the put option, we just let it expire, we will waste $2,500 and get this amount of money. But on the other hand, if the stock prices will decline to $50, we will actually exercise our option and sell it for $75 a piece. And this will make us this amount of money. Again, if the stock prices will decline even further, the minimum amount of money we will get will be this. So again, in this case, we try to protect profits, not protect ourselves from potential losses. Now let's look at the other side of the market, how options can protect a short position. So far we have talked about using puts to hedge long position, but if you have sold a stock short, meaning you borrowed shares and sold them, hoping to buy them back later at lower price, your biggest risk is that the stock rises instead of falling. So that's where a call hedge comes in. Here's how it works. You sell this stock short, betting the price will drop. To protect yourself, you buy call option on the same stock. And well, if the stock falls, you'll profit from your short position. If the stock raises instead, the call option gains value, letting you buy the stock at the strike price and close your short position before losses get out of control. It's essentially an insurance policy for short sellers, capping your potential losses while keeping most of your potential gains. Why do you think it's especially important for short sellers to hedge their position compared to regular stock investors? Well, because short sellers face unlimited loss potential. A stock price can theoretically rise forever. Long investors can only lose what they put in, but short sellers can lose far more. A hedge puts a ceiling on that risk, preventing catastrophic losses if the market moves sharply against them, for example. So up until now, we have been focusing on buying options, but there is another side to this market, writing options or selling them. When you write an option, you are taking the opposite bet of the buyer. You're essentially saying, I don't think the stock will move as much as the buyer expects. If you write, the option expires worthless, and you can keep the premium as profit. That's why writing options can feel like easy money. You get paid upfront, but there is a catch. Your maximum profit is limited to the premium received, while your potential loss can be very large if the market moves against you. There are two main ways to write options. The first one is naked options. The writer does not own the underlying stock. This is highly risky, very risky. If the option goes in the money, the writer must buy the stock at market price with potentially unlimited losses. Another one is covered options. The writer does own the stock. This greatly reduces the risk, since the stock you already own can be delivered if the option is exercised. The loss is limited to the difference between your stock cost and the strike price. So writing options is a trade-off between steady income and significant risk, so to speak, like earning small insurance premiums, but occasionally facing a big claim. So here's a perfect illustration of one of the most popular income strategies among investors, the covered call. In this example, the investor owns a stock currently worth $73.50 and sell a 3-month call with $80 strike for a $2.50 per share. By selling that call, they collect an immediate $250 premium, since each contract covers 100 shares. Now let's see what happens in a few different scenarios. If the stock stays flat at 73.50, the call expires worthless. The investor keeps the $25 premium plus 100% in dividends, a total profit of $350. So this is over here. If the stock rises to $80, the call is exercised. The investor sells the stock at 80, gaining $650 on the stock plus the $250 premium and $100 in dividends. So the second option over here. So the maximum profit will be $1,000 for him. If the stock keeps rising to 90, the investor still only gains the same amount, $1 total. Why? Because they gave up additional upside by selling the call. The call writer must sell at 80, even if the stock climbs higher. If the stock drops to $71, the investor loses $2,500 on the stock, but still keeps the $25 premium and $100 in dividends, netting a small profit of $100. So a covered call limits upside, but provides steady income and mild protection to the downside. It's a strategy for investors who are moderately bullish, expecting the stock to stay at this same or rise just a little. Here we move from simple option trades to the spreading strategies, which combine 2 or more options in a single position to fine-tune risk and return. It's called option spreading, and it's one of the most flexible tools traders use. In a spread, you buy one option and sell other, with difference in either strike price, expiration date, or both. There are many variations: bull spread, bear spread, money spread, vertical spread, butterfly spread, and more. But they all share a common goal, to take advantage of difference in option prices and premiums while limiting risk. For example, a bull spread might involve buying a call at a lower strike and selling another at a higher strike. That caps your profit if the stock rises, but also reduces the cost of the trade. So a perfect middle ground between speculation and safety. So option spreads are about precision. They let you shape your payoff curve exactly how you want it, balancing cost, probability, and potential reward. And why might a trader prefer to use a spread instead of buying a single call or put option? Well, because spreads reduce cost and risk. By selling one option while buying another, the trader lowers the net premium and limits potential losses. The trade-off is capped profits. Spread are a way to make a more controlled, lower cost bet on direction or volatility rather than an all or nothing gamble. So this slide introduces one of the most common flexible spread strategies, the vertical spread. Each type of spread serves as a specific purpose, but the vertical spread is the foundation of many of them. It involves buying and selling options, let me see. Yes, buying and selling options of the same type, both calls or both puts on the same stock with the same expiration date, but different strike prices. So for example, a trader might buy a call at a lower strike price and sell a call at the higher strike price. It creates what's called the bull call spread. You are betting the stock will go up, but not too much. The sold call helps offset the cost of the bought call, lowering your total investment. The trade-off is that your profits are capped at the higher strike price. Alternatively, if you expect the stock to drop, you could reverse the setup with puts to create a bear put spread. Vertical spreads are all about balance, limited risk, limited reward, and a clear payoff structure. So the risk is smaller than what we have in the case of the naked option, but it's still there, and if the stock doesn't move as expected, both options can lose value together. So why might an investor choose a vertical spread over simply buying a single call or put? Because the vertical spread reduces the upfront cost and limit risk. By selling one option, the investor collects premium income to offset the cost of the other. The trade-off is giving up unlimited profit potential, in other words, sacrificing some upside for lower cost and defined risk. Now, let's look at one of the most interesting advanced strategies, the option straddle. A straddle involves buying or selling both a call and a put on the same stock with the same strike price and the same expiration. Why would anyone do that? Because a straddle is a bet on volatility, but not direction. When you buy a straddle, you don't care which way the stock moves. You just need it to move a lot. If the price jumps sharply up, the call becomes valuable. If the plunges, the put pays off. Either way, one side wins big, and the most you can lose is the total premium you paid for both options. On the other hand, if the stock stays flat and doesn't move much, both options expire worthless. That's the risk. There's also a reverse version, a short straddle, where you sell both the call and put, collecting premiums upfront. That one profits if the stock stays quiet, but losers can explode if it moves too far. So why might traders choose to buy straddle right before major company announcement, like earnings, producers launches? Well, because those events often trigger big price swings, but it's hard to know the direction of advance in advance. So buying a straddle leads traders profit from volatility itself, not from predicting whether the news will be good or bad. It's classic direction neutral bet on the movement, so to speak. So in this slide, we wrap up the discussion on straddles, showing the two versions, the long straddle and the short straddle. Again, the long straddle means you buy one call and one put with a same strike and expiration date. You're betting on the movement, any big move. If the stock surges, your call skyrockets in the value. If it crashes, your put explodes in value. As long as one side gains exceeds the total cost of the both options, you make a profit. It's a classic play when you expect high volatility, like before an earning announcement or a big economic report. Short straddle is the opposite. You sell both call and put options, collecting both premiums upfront. You are betting on stability, hoping the stock stays near the strike price. If it barely moves, both options expire worthless, and you keep the premiums. Easy money in full markets. But if the stock makes a big move in either direction, losses can pile up quickly, and for call writers, losses are potentially unlimited. So, very brief summary: long straddle is a profit on the chaos, and short straddle is profit from the call. So if both long and short straddles involve the same two options, why does one benefit from volatility while the other suffers from it? Because the long straddle buyer pays a fixed cost for unlimited movement potential. Volatility increases the chance of the big payoff. On the other hand, the short straddle seller collects limited income, but faces large or unlimited losses if volatility spikes. In short, one owes volatility, the other is selling it. So up to now, we have focused on options written on individual stocks, but options can also be written on entire stock market indexes, like S&P 500, the Nasdaq 100, or Russell 2000. These are called stock index options, and they have been around since 1983. They have grown extremely popular among both institutional and individual investors because they allow traders to take positions on the overall market, not just one company. An index option works just like a stock option. You can buy calls if you expect the market to rise, or puts if you expect it to fall. The difference is that instead of receiving or delivering shares, index options are typically cash settled based on the level of index at expiration. For investors, index options are a powerful tool for hedging portfolios against market downturns and speculating on broad market moves without picking individual stocks. So in the next slides, we'll look at their contract details and other specialized types of options that serve different investment goals. So a stock index options is simply a call or put written on the market index. It's like the S&P 500 or Nasdaq 100 instead of the individual stock. The underlying security isn't just an actual share, it's the index level itself. Because you can't physically buy or deliver an index, these options are cash settled. That means that when the option expires, profits and losses are paid out in cash. No shares ever change hands. The cash value of contract equals 100 times the index level. For example, if S&P 500 is $4,800 and you hold one call, each point is worth $100. If the index rises 10 points, that's a $1,000 gain. Index options can be American or European style. Most US index options are European, meaning they can only be exercised at their expiration, which simplifies the settlement. The most common index options trade on S&P 500, the benchmark for institutional hedging, Russell 2000, small cap exposure, Nasdaq 100, which are tech-savvy focused, and Dow Jones Industrial Average. So this figure shows what real index option quotation looks like. Here for the S&P 500 index, just like stock options, each row lists the strike prices, expiration dates, and bid-ask quotes for both calls and puts, along with trading volume and option interest and open interest. The big difference is that instead of the share prices, everything here is expressed in the index points. For example, the closing level of S&P 500 on this day was $28,000. So the strikes you see is $2,780, $2,790, and $2,800, etc. represent index levels, not stock prices. So each point is worth $100 per contract. So move from 28 to 2810 means $1,000 change in the value per contract. Here we look at how stock index options are valued, the mechanics behind what determines their price. Just like individual stock options, the market price of an index option depends on the difference between the index current level and the option strike or price. For example, if the S&P 500 is at $48,000 and you hold a call with a strike of $4,700, the option is in the money by 100 points. That is $10,000 per contract, since each point equals $100. Aside from that, index options behave like any other option. Their value is influenced by volatility, time to expiration, and interest rates. There are also two pricing categories, full value and fraction value options. Most major broad-based index options like the S&P 500 or Nasdaq 100 use the full index value for trading and valuation, but there are exceptions, such as the Dow Jones Industrial Average and Dow transportation average, which are priced on a fractional or mini basis. The smaller contracts make index options accessible to individual investors by reducing the contract dollar value. So whether you are trading the full S&P/X or a mini Dow option, the principle is the same. Each represents a leveraged bet on the direction of the entire market. So why do you think exchanges created mini or fractional value index options when the full value contracts already existed? Because full value contracts are often too large and expensive for smaller investors. One S&P/X contract can represent hundreds of thousands of dollars in exposure. Mini or fractional options lower the contract size and risk, making index trading accessible to more participants and increasing overall market liquidity. So if you hold a diversified stock portfolio, you can protect it from a market downturn by buying put option on stock index like S&P 500. Here how it works. If the market goes down, your stock portfolio will lose value, but your index puts will gain. Those profits can offset your portfolio losses or even give you cash to buy more stocks at bargaining price. If the market goes up, the puts expire worthless, but you still benefit from your portfolio rising value. The only cost is the premium you paid for the puts, like paying an insurance premium that you hope you won't need. The catch, this protection can be very expensive during volatile markets. When everyone's afraid, the cost of index puts can rise by 20-30% or more above the intrinsic value, and exactly when the investors want it the most. Finally, it's crucial to match your hedge. Choose an index that best mirrors your portfolio. If you hold mostly large cap stocks, hedge with S&P 500 put. If you hold small caps, maybe Russell $200 put fits better. So before we move further, it's important to pause and give a word of caution about trading index options. While index options can be incredibly powerful for hedging or speculation, they also come with high risk and significant price volatility because they reflect the movement of entire markets. Even small percentage changes in the index can cause big swings in the option prices. That's why index options are not for beginners. They require constant monitoring and a good understanding of how factors like volatility, time decay, and interest rates interact. These aren't the kind of investments you can just buy and forget. Option values can change dramatically within hours, even minutes, depending on what's happening in the markets. Professional traders often manage them daily, adjusting or closing positions as conditions shift. So while index options can enhance returns and protect portfolios, they demand discipline and attention, the same way you would handle any high-powered financial instrument. Now we move beyond stock indexes into some other type of options, ones written on ETFs and interest rates. First, options on exchange or traded funds. This puts and calls written on ETFs like SPY or QQQ. They function almost identically to index options, but since ETFs actually trade like stocks, they can be physically settled rather than cash settled. That makes ETFs options a favorite among retail investors. They allow you to trade an entire index with a single stock-like instrument. Next, interest rate options. These options are written on fixed income securities, primarily US Treasuries with 30-year, 10-year, and 5-year or 13 weeks maturities. Unlike stock options, these track the yield on the bond, not its price. So here is the key relationship. When bond price fall, yield rise, and interest rates call, options gain value. When bond prices rise, yields fall, and put options gain value. So in short, interest rate options are tools for managing exposure to movements in interest rates rather than stock prices, making them critical for banks, pension funds, and bond portfolio managers. A kind of interesting question to think about. If interest rate call options gain value when bond price fall, what type of investor would most likely buy them? And the answer is that investors worried about rising interest rates, such as bondholders or mortgage lenders, When rates rise, their bond portfolios lose value, but owing interest rates, calls provide a hedge. The call gains offset some of those losses. This final slide introduces two specialized types of options, currency options and LEAPs, both which expand how investors can manage risk and time horizons. First, currency options are puts and calls written on major world currencies like the euro, yen, pound, or Canadian dollar. Their value depends on exchange rate movements between the US dollar and the foreign currency. For example, an American exporter expecting payment in euros might buy a put on the euro, protecting against the risk that the euro value will fall before payment arrives. Conversely, an importer paying in yen might buy a call on the yen to lock in costs with the yen strength. In short, currency options are vital for managing foreign exchange risk in international trade. Next, LEAPs, long-term equity anticipation securities, are simply long-term options with expiration up to 3 years compared to the usual 8 months or less. They are available on hundreds of stocks, indexes, and ETFs, and because they have so much time value, they are more expensive. LEAPs are popular with long-term investors who want to control large positions or hedge portfolios without committing the full cost of buying or selling the underlying securities. So this table shows how foreign currency options are standardized for trading on the Philadelphia Exchange, one of the major markets for these contracts. Each option contract is written on a fixed amount of a major currency. For example, 10,000 pounds for the British pound, $1,000 euros, $10,000 Swiss francs, $10,000 Canadian or Australian dollars, and $10,000 yen for the Japanese currency. So this contract sizes makes it easy for traders, companies, or investors to hedge predictable currency exposures like an upcoming payment or invoice in a foreign currency. There's also an important detail on how these are quoted. Most currencies, the pound, euro, franc, and dollar, are quoted in full US cents. The Japanese yen, because it trades at a much lower dollar value, is quoted in hundreds of cents. That's because $1 equals roughly 100 to 150 yen, so quoting in hundreds of a cent provides finer precision. In short, these standardized contracts make global currency trading and hedging accessible, predictable, and transparent. So this is it for option contracts. Thank you guys for listening. I really appreciate your time. See you in class. Bye.